So now we're going to use the production budget we just came up with in order to determine the direct materials that we need to produce those units. Remember, to make a product, it's composed of 3 items: direct materials, direct labor, and overhead. So we're going to start with direct materials. In order to do this, we need more assumptions. So our assumption is that 5 pounds of material are required per unit, and management wants materials on hand at the end of each month to equal 10% of the following month's production. Again, that's our buffer in case we're off in our sales budget, which is the driving force for all the budgets. We want to have this wiggle room so we don't run out of supplies. And then it tells us at the end of March, we had 13,000 pounds of material on hand and that the material costs 40 cents a pound. So we're going to do this direct materials budget much like we did our production budget. So we start with our production for each month of the quarter, and then there's an extra step because we have to convert units to pounds of material. So we're going to multiply the production in units times the 5 pounds needed per unit to figure out how many pounds of material we need for each month. And then we're going to go through that same process for the production budget. We'll add our desired ending inventory, take out our beginning inventory, and that'll tell us how much we need to buy. The ending inventory is going to be 10% of the following month's production needs. So 10% of 230,000 rather is 23,000. And then the beginning inventory comes from the previous month's ending. So they told us March 31 inventory was 13,000. Again, if they didn't give us that number, we can always get the beginning by looking at the current month's production. So we have April production needs is 130,000 pounds. That's for April. Times the 10% is where that 13,000 March 31 number comes from. Again, we might be given the March 31 number and it might not be in compliance with our assumptions because reality may differ from our assumptions. So just use the number that's given, but I'm trying to get across the point that ending inventory is whatever percent of the next month, and beginning would be that same percent of the current month's production needs. So now it's saying, why don't you calculate the materials to be purchased in May? So you can give that a go, pause the video, and then we will do it. So if you pause the video, you should now have an answer, and hopefully that answer was 221,500. How do you get that? Well, you're going to first take your desired ending inventory for April. That becomes beginning for May. The desired ending inventory for May would be 10% times the 145,000 pounds we need in June because we want 10% of the following month. And then when you add it all together, you get to 21,500. For June, just in case you're not catching on yet, we'll go through and just do it real quick before I click the button. The ending inventory for May becomes the beginning in June. The desired ending inventory for June would be 10% of July. In order for us to figure out the 10% of July's, we would need to know what July's production needs are. So they would have to give us that information. I don't know how that just happened. So our July production needs are 115. So then we would take, that would have to be given again. They'd have to tell us that amount. And then we'd multiply that by 10%. And then we would get 11,500. And then we can finish it up. So 145 plus 11,500 is 156,500 minus 14,500 is 142. Here it is all typed and pretty. And then you have to remember that we take our desired ending inventory from June. That's the ending inventory for the quarter. And the beginning inventory from April would be the beginning inventory for the quarter. So for inventory, we don't add them up. They're at a point in time. The end is from the last month. The beginning is from the first month. Now we know Royal pays 40 cents a pound, and now there's some more assumptions. One half of the month's purchases is paid in the month of purchase, the other half in the following month. And then we have a payable from March of 12 grand, which will be paid in April. So like our cash receipts budget, we're going to do a cash disbursements budget. So the account payable that was due at the end of March is paid for in April. And then for April purchases, 50% of those purchases, which if I go back, April purchases were 140,000 pounds. So there's a lot of back and forth to follow all these numbers. But we take the 140,000 pounds times the 40 cents a pound. That's where that 56,000 came from. Half is going to be paid in April, half in the next month of May. And then we would do the same thing for the other months. So here it's asking, what are the total cash disbursements for the quarter? So you basically need to go through and complete this schedule for May, adding in May purchases and June purchases to it. And to do that, you're going to have to go back all the way to here where you've got your May and your June purchase numbers. You'll have to convert those to dollars, and then 50% is paid in the month of purchase, 50% in the following month. So if you try that out on your own, you'll be able to get your answer, which is 185. How do you get it? Well, you should have figured out that your May purchases in dollars was 88.6. 50% of that's paid in May, the other 50% in June, and then June purchases were 56.8, 50% in June, and the other 50% won't be paid until July, which means the account payable at the end of the quarter, at the end of June, would be 28,400, because 28,400 or half of the 56.8 is paid for in June, the other half hasn't been paid. So it's a payable. Remember, when we have cash receipts, that's the amount of money we receive. The amount we haven't received is our receivable. Likewise, with cash disbursements, the amount we pay is our cash disbursement. The amount we have not paid would be our payable. The next component to producing a product is direct labor, so we're going to need some more assumptions. It says each unit of product requires 0.05 hours of direct labor. The labor can be unskilled because the production process is simple. Who cares? It's just additional detail. And then we pay our employees $10 an hour. So how are we going to create our labor budget? Well, we're going to use some common sense. We're going to start with the units we produce each period, which came from the production budget. Then we're going to multiply that by the amount of time each one requires, which is 0.05, and that'll give us our labor hours required each month. Then, as you can guess, you'd multiply that by the labor rate to get the total direct labor cost. Because these are income statement items, the total cost, total units, total hours, and finally total costs are just added across the 3 months to get your quarterly numbers. The last component of product cost is overhead. So guess what? We're going to need even more assumptions. So at Royal, overheads applied basis of direct labor hours. The variable overhead rate's $20 a direct labor hour. Fixed is $50,000 a month, which includes $20,000 in non-cash costs, primarily depreciation. Depreciation is non-cash, remember, from financial accounting, because you don't pay depreciation. You buy a piece of equipment or you buy property, and then depreciation is just the allocation of that cost over time. So you already paid for it. So when you record the depreciation, it's a non-cash expense. There's no more cash going out. Why is that going to be important? Well, when we calculate cash disbursements for overhead, we're going to need to remember that depreciation is not paid in cash. So it's quite simple to do this. We're basing it on direct labor hours. So we're going to get our direct labor hours from our direct labor budget that we just created. And then we know our variable overhead rate's given at $20 an hour. So we just take our hours times our rate to get our total variable overhead. Our fixed overhead costs are a constant 50 each period. And then we just add it up to get our total overhead costs. Because these are estimates, we would use this budget to create our predetermined overhead rate, which is our estimated overhead for the quarter, which would be that 251, divided by the estimated hours, which are the 50/50. So that would be the predetermined overhead rate that the company would use. Because remember, budgets are all estimates, so all of these numbers are estimates. In order to figure out the cash disbursements, we take out the non-cash costs. So our total overhead costs less the non-cash 20 grand would be the cash amount that we would need to pay for the overhead. And that gives us the 56, 76, and 59 for a total of 191 that's going to be paid out for our overhead cost. Depreciation is non-cash, therefore it's part of our expenses on our income statement, but it wouldn't be part of our cash outflows. The last step is going to be to create a finished goods inventory budget. And to do this, we need to be able to figure out what our product cost is. So if you remember, under absorption costing, we include direct materials, direct labor, variable overhead, and fixed overhead in our product cost. Our direct materials, which would come from our direct materials budget and assumptions, would be 5 pounds of material a unit at 40 cents. Those were assumptions provided. All we're doing here is the math to figure out that the materials cost per unit is $2. For labor, it's the same idea. It was 0.05 hours per unit times $10 an hour to get our direct labor cost of 50 cents a unit. And then for overhead applied, it's going to be that overhead rate we just calculated, $49.70 times the 0.05 direct labor hours, which is our allocation base, to get the overhead cost of $249. Add that all together, and our product cost per unit is $4.99. So in order to figure out our ending finished goods inventory, we need to know our ending inventory in units, and then we multiply by the $4.99 to get our ending finished goods inventory. So the ending inventory in units is 5,000. That's going to come from our production budget. And then our unit product cost is $4.99. So that gets us our ending finished goods inventory for our balance sheet, which would be $24,950. So really, when you're budgeting, the numbers come from all the previous budgets, so you kind of need to be able to go back and forth, and I recommend that you do that. I'm not going to spend the time clicking back to go to the production budget in the video, but there's no reason you can't look at the PowerPoint slides and go back and verify that the ending inventory on the production budget for the quarter was 5,000, and then we multiply that by the cost per unit in order to figure out the ending finished goods inventory, which will go on to the company's balance sheet. Again, that 5,000 comes from our production budget.